How a rocket company became a vehicle for consolidating debt, risk, and future narratives. SpaceX transformed launch economics, pioneered reusable rockets, expanded access to space, and built one of the most important communications networks on Earth through Starlink. These accomplishments are real and deserve recognition. The purpose of this article is narrower. It examines whether the valuation, balance sheet structure, governance arrangements, related party transactions, and capital allocation choices disclosed in the IPO filing justify the assumptions embedded in a $1.75 trillion valuation. Engineering success and investment merit are not the same question. A company can be extraordinary technologically and still be priced beyond reasonable expectations. This essay addresses the second question, not the first. The roadshow presents a destination. The filing presents a balance sheet. Serious investors should read both. The debate surrounding the SpaceX IPO has become trapped in the wrong argument. One side sees Mars, the other sees hype. Both are missing the central issue. The real question is not whether Mars is possible. The real question is whether one of the largest valuations in financial history is being used to consolidate unrelated businesses, unrelated debts, unrelated risks, and unrelated future promises into a single financial instrument that public investors are now being asked to purchase. Let us begin with what is real. Reusable rockets are real. Starlink is real. Launch cadence is real. SpaceX has achieved engineering feats that deserve genuine admiration. This essay is not an argument against science or ambition. It is an argument about capital allocation. Because somewhere along the way, a launch company became something else. Twitter was acquired for approximately $44 billion and presented as the future global public square. That vision did not justify the price paid. AI was launched to compete at the frontier of artificial intelligence and accumulated billions in operating losses. Grok was promoted as a challenger to OpenAI and Anthropic. Yet, in an irony worth noting, the most visible AI revenue disclosed in the filing comes not from Grok displacing Anthropic, but from providing infrastructure to Anthropic. Anthropic became the customer. The filing reveals that approximately $20 billion of bridge financing was raised in March 2026, 2 months before the IPO, and used to refinance obligations associated with X and XAI, absorbing approximately $1.163 billion in prepayment penalties. The S1 states that IPO proceeds may be required to repay this bridge loan within 6 months of listing. Twitter was not SpaceX. Twitter was not Starlink. Twitter was not Mars. Why should investors buying a rocket company ultimately become responsible for obligations created elsewhere? The filing discloses an accumulated deficit of approximately $41.3 billion. The AI segment reported approximately $6.35 billion in operating losses during 2025 and continued losing billions in the opening months of 2026. At the same time, the company spent approximately $2.41 billion repurchasing stock from XAI employees and another $1.93 billion providing liquidity to existing shareholders before the IPO. The IPO is not simply financing the future, it is also refinancing the past. Then comes the governance question. The filing discloses more than $20 billion of AI infrastructure obligations tied to arrangements involving Valor Equity Partners. Antonio Gracias, founder of Valor, sits on the SpaceX board. PwC, SpaceX's own auditor, classified these arrangements as failed sale-leasebacks and recorded them as debt. The company paid approximately $885 million under these arrangements in 2025 and another $857 million in the first 2 months of 2026. At the IPO valuation, Gracias's holdings become worth tens of billions of dollars. When board members stand on both sides of transactions of this scale, governance becomes as important as engineering. Then there is Cursor. SpaceX announced in April 2026 the right to acquire the AI coding startup for $60 billion, expected to close shortly after listing. If SpaceX walks away, it reportedly owes Cursor approximately $10 billion regardless, effectively transferring a substantial obligation onto future public shareholders merely for declining the transaction. Now, the simplest and most important question: is there enough real work for Starship to justify the valuation? The confirmed work today is Starlink deployment, NASA lunar contracts, national security launches, and commercial payload services. That is a real business and a valuable one. But the valuation prices in orbital AI infrastructure, Mars colonization, Starship becoming a transformational logistics platform, artificial intelligence dominance, and communications growth, all simultaneously. Starlink must continue compounding despite declining average revenue per user and increasing competition. Starship must achieve commercial economics at scale while continuing to navigate the technical, regulatory, and operational challenges inherent in a developmental launch system. XAI must grow from a relatively small market position into a dominant one. Not one thing, everything. The gap between confirmed work and priced in work is where the extraordinary premium resides. Rockets need markets. Markets need customers. Customers need economics that work. That is why I call this the hodgepodge economy. Not because the individual businesses lack merit, but because the structure increasingly resembles a collection of unrelated narratives held together by a single extraordinary market capitalization. If one vision weakens, another is attached. If Twitter weakens, it folds into AI. If Grok weakens, Colossus becomes a compute landlord. If orbital AI encounters physical constraints, the narrative shifts toward civilization insurance. The story keeps moving. The capital requirement keeps growing. The burden of proof should grow with it. Investors deserve to know whether they are buying a launch company, a satellite communications business, an AI company, a social media platform, a civilization insurance policy, or a mechanism through which all of these stories are being financed simultaneously while earlier obligations are refinanced through the proceeds. The roadshow sells a destination. The filing describes the balance sheet. Serious investors should read both. Because valuations are not sustained by narratives, they are sustained by cash flows, and every future promise must eventually pass that test, because physics collects every debt. Markets eventually do the same.